For the first topic today, I'm going to be going over the Trump versus Biden tax plan. My initial disclaimer that I want to put on this is that we don't have all the information as these plans are not fully fleshed out. And we also need to keep in mind that these plans are not, set in stone because Congress has the power of the purse, the president does not. And generally speaking, presidential budgets and tax policies are a little bit more than than political and economic theater. It usually doesn't end up exactly the way that they want it. So keep that in mind and take that with a grain of salt as I go over this. Also, I'm going to be doing this mostly as a comparison with Donald Trump's current tax plan because Trump is currently the president. And, I'm going to be talking more about what the changes that Biden is planning on implementing. I will be touching on a couple topics that Trump has talked about implementing going forward as well, though. And I'll be doing a compare and contrast throughout the remainder of this topic. So first of all, I want to focus again on the average American and how these policies are going to affect them. So I want to start off by pointing out that I'm going to be looking from the perspective of the average American, which the median for the average American net worth is $50,000, and the median household income, that's household, not individual income, is about $60,000 per year. And I'll show you guys some stuff real quick to give you a better picture of what I'm talking about. Awesome. Cool. Now, when we're looking at this, we want to see that the median, and this is according to the census, and then Business Insider are the two sources that I'm looking at right now. But when we're looking at the median income, we can see that, as late as 2018, it was around $60,000 per year. So that's going to be important to keep in mind throughout the rest of this so that we understand when we're talking about different tax brackets, what percentage of the American population that's actually affecting. Also, I want to point out that it's going to vary widely by state because states obviously have very different cost of livings and very different average pays. And there's a map here. And this basically shows, this is a really good article that I'll have linked, and it basically shows you the breakdown of where I got that information. So that way you have an idea and can follow along if you wish. Also, I wanted to show this map just so we have a decent idea of how this is going to affect different states, relatively speaking to their general political preferences. So as we know, from looking at the Trump electoral map from 2016, we know that most of the center of the country was red, especially the South, with mostly the West and East coasts being blue. I think this is something that's really important to remember because as we look here on this chart, we can see that the median household income is the lowest in these white states, and the lighter the state, the lower the median household income. So that's going to mean that any of these tax policies that are going to benefit lower income Americans are going to disproportionately benefit those in the lighter colored and generally speaking red states. So let's keep that in mind going forward. As for the plan, we're going to start off talking about each individual tax, and I'm going to go over explaining what they are, what they're actually looking at, and how they affect you. So let's start with Biden's plan, and the first thing is income tax. So it was claimed on the last night of the RNC, the Republican National Convention, by Trump that Biden would raise taxes on almost all American families, and it was also claimed during the RNC by Eric Trump that 82% of Americans would see their taxes go up significantly under Biden's plan. Now, currently, the top marginal tax bracket in the United States is at $518,400, and then everything above that is taxed at a 37% rate. Biden hasn't mentioned anything about changing the brackets below the top income bracket. What he stated is that he will not increase the taxes on anyone making more than $400,000, which is less than 2% of Americans. And he also presumably, right, because essentially when you look at Biden's plan, what he's stated, the specifics he's given are that he wants to move the top tax income tax bracket up to 39.6% from the 37% that it currently is. And given that that is the percentage that Obama taxed in the top income bracket, and that Obama had the top income bracket set at 400,000 for individuals and 450 for joint filers. I have to assume that that is what he's following whenever he says the specific of not making 400,000 or more. Anyone other than that pay more in taxes. So I'm going to assume going forward that Biden's specific plan is 39.6% for the top income bracket, and that's going to start at 400,000 per year, which basically means that he wants the income tax to be the way it was under Obama. He wants to revert back to what it was before the 2017 tax cuts. Now, to understand where this fits in historically, I think it's really important to look and see how tax rates have changed over time. And this is going to be according to the Tax Policy Center. And again, all the links will be in the bio below. And basically, when we are looking at income rates and the highest marginal income rates. So if anyone doesn't know how marginal income tax works, basically there are certain brackets, and up until you meet each of those thresholds, then you are taxed at a different percentage. So as an example, if the marginal income tax doesn't start until $30,000, then for the first $30,000, you would pay no income tax. If it's then, 10% or 20% or whatever the percentage is after that, then you will be taxed at that percentage from that point until the next bracket, which then every dollar after that will be taxed at the higher percentage. So when he says he's going to raise the top income tax bracket, unless you're making above that threshold, that is not going to affect your income tax. So I want to make sure that's really clear. And I also want to make sure that when we're looking at this chart, that we're understanding that this is very simplified, and this is just looking at what the percentage is on the top tax bracket. It is not keeping in mind things like changes in itemization, i.e. lowering your taxable income, what those limits were that year. It doesn't consider what the price was, like what the salary was in that top income bracket. And that's something just to keep in mind, and understand that when we're looking at this, this is not all the information, because you aren't going to be able to put all of that in one chart. But basically, when we look, we can see historically that U.S. tax rates, like on income, peaked in about the 1950s and early 1960s right here. And that was in the 90%. And so when we're thinking about taxation, I think it's really important for us to have a historical perspective and understand that, when we say taxes are low or high, we need to be very historically aware of what that means in context, and understand that we've had historically very low taxes since, essentially the second Reagan term. And you can see that really clearly on here. Reagan came into office in 1980. Taxes were at 70%. By the end of his first term, he had already cut them down about 50%. Like he had cut them 50% down to, a 50% rate. And then by the end of his second term, he had cut that in half again. So really big drops during the Reagan administration. And since then, we haven't gotten above 40% again, despite being far higher than that throughout most of the modern U.S. tax history. So important to understand when we're going forward. As we're looking at this, that really puts in perspective that there's nothing really radical about Biden's plan. Whether you have preconceived notions, which we all do. There's nothing radical about it. It's, like I said, it's just removing the 2017 tax cuts, and that's important to understand. Also, again, if you're under 400K as an individual or under 450 filing jointly, then there should be no increase in your income tax directly. So now let's move on to the next set of taxes. So the next set of taxes is payroll taxes. So payroll taxes, when you look on if you're a normal W-2 employee, if you look on your pay stub, you will see a section that is SSDI, Social Security Disability Insurance. And this section that is taken auto-deducted from your pay, that is your payroll tax. And that is used to fund Social Security, Currently, it's 12.4%, and that's cut in half, with 6.2% coming from the employee's paycheck and 6.2% coming from the employer before the employee ever sees it. And I talked about in the last podcast about Trump wanting to remove the payroll tax for the next 6 months, and about the implications with that. So be sure to check that out if you want a understanding of what his full policy ideas are around the payroll tax. But currently, like I said, it's 6.2% for employee, 6.2% for the employer, and that's capped at $137,000 earned per year. So, and this increases with inflation annually. So the idea is that up until $137,000, you will pay that 6.2% on every dollar earned. But then once you get past $137,000, you pay no more taxes in the form of payroll taxes to Social Security. So high earners are generally, they're not paying any taxes towards the Social Security disability insurance beyond that point. And Biden's proposal on this is that he wants to start taxing the payroll tax again at $400,000, and because of the fact that the threshold currently at $137 increases with inflation annually, then over time that $137 would continue to increase so that it would meet the $400,000. And what this would do from a long-term standpoint is get it so that everyone in the United States, regardless of income, is putting something into Social Security. And that way we have, it for the future. And it's really important. Again, I mentioned this in the last time I talked about the Trump payroll tax. I think it's really important to understand how, big of a deal Social Security is, because as millennials, I think we've all kind of reserved ourselves that we shouldn't count on it, but we need to keep in mind that currently about 60% of people that are age 70 plus rely on over 50% of their income from Social Security. And that will be linked below, but that's according to the Social Security Administration. And also it's really important that as millennials, we are way behind them. They're relying on it at this time. And as far as our net worth, we are way lagging behind the baby boomers and the Gen Xers. So most likely we will end up needing to rely more on this type of income when we get to retirement age, assuming that it is going to still be around. So I think that's something that we all need to understand when we go and vote, and how that's going to affect us long term, because that is something that most of us don't think about when we're under 30. The next set of taxes are investment taxes. So this is probably and estate taxes are the next three basically are the big differences for the Biden versus Trump tax plan. So investment taxes. So currently the top rate on long-term capital gains and qualified dividend income is 20%. Now, what this essentially means, so long-term capital gains are if you have an asset and it appreciates in value over time, and then you sell that asset for a gain, then you would pay long-term capital gains if that asset has been held for over a year. If it has not been, then you would pay short-term capital gains on it, which is at a higher tax rate. Currently, our tax rates in the United States for long-term capital gains are 0, 15, and 20% depending on your tax bracket for long-term capital gains. However, for short-term capital gains, they are taxed at whatever your highest income bracket is. This is really important because, as an example I talked about in my Dave Portnoy video, someone who makes that much money is being taxed currently at the highest bracket of 37%. And so if he's buying stocks in a day trading or a swing trading fashion where he's selling them short term, the taxes he's paying are basically double, 37% instead of 20%. And that's why the more money that you make in our current tax system, you're going to lose a lot of money in taxes by doing short-term trades. And that's why you see a lot of people that are very well off really like dividend income because of the lower tax burden if it's a qualified dividend. And that's important to understand as well, because not all dividends are taxed the same way. And so you need to be very scrupulous and make sure you understand whatever dividend investments you are making. But this is why you have situations like in 2012 when Mitt Romney was running for president, talking about how low of a tax rate that he paid. And also Warren Buffett, famously saying that he pays less taxes than his secretary. That's because the difference in the taxes on earned income for the average American and the taxes on capital gains for the investor class. And that's something that Biden is trying to change with his tax proposal. So what Biden wants to do is he wants to make it so that that exception for long-term capital gains pretty much goes away. He wants, not for everyone though, and that's the key thing to remember here, is he wants it so that your long-term capital gains and qualified dividends are still taxed at the top income bracket that you have. But he wants to do that only for people that are making investment income of over $1 million per year. So back to our, what does the average American have when we're looking at median net worth? The median net worth of someone in the United States is $50,000. People making over $1 million a year, that is an infinitesimally small group of people that this is going to affect. That being said, this is definitely a big deal as far as donors are concerned, because the people that are going to be affected are going to be the people that are donating to these campaigns. And so this is a really big difference for the rich investor class, and may end up having some, backlash when it comes to, the stock market. It may have a little bit of an adjustment period because you're going to have less speculation, most likely, if people are going to be punished with those, increased taxation on trades. And that's something to keep in mind. The next one we're going to focus on is estate taxes. So here again, an estate tax is a tax on the monetary value of whatever it is you inherit when, you inherit an estate from a loved one or parent. And currently the estate tax is a flat 40% tax, and it only starts after the first 11.58 million per individual and 23.16 million per couple. So what this means is that if you have $11.57 million in assets when you die, and you pass that on to your child, they will not pay, any estate tax in that. So the first 11.58, not an issue. After that, what he wants to do is, instead of taxing it at a 40% level, what he wants to do is tax it at a graduated, or he hasn't said this specifically, but this is what Obama did, and it's pretty much the same plan, is he wants to start taxing it, graduatedly, so progressively from 40% to 77%. And that way it's, it's helping get more money from the people that are benefiting the most, holding these assets. Now, the bigger thing that he wants to do is remove the stepped up tax basis. And this is a really cool thing that Meet Kevin is a really good YouTuber that talks about this. But the stepped up tax basis is essentially a rule where if, say, I buy a property, and it's also important to remember that, again, this is within the estate tax, so it has to meet the threshold of 11.58 million. So say that I had $20 million worth of property, then what would happen is that the first 11,000 wouldn't even touch anyway, or 11 million wouldn't even touch anyway. Then the next, let's make it 21 for ease of math. So the next 10 million would be subject to that tax. However, if I were to say I bought that at, something obscene, like 5 million, right? Let's say I bought it at 5 million. If I had bought that at $5 million, if I were to sell that property before I died for the $20 million, I would then pay long-term capital gains tax, presumably that I'd held it, long enough for that. I would pay long-term capital gains tax on that entire growth of that $15 million. And instead, what the stepped up tax basis allows is when I die, if I don't sell it and I just let my kids inherit that, then they would only pay the tax, the capital gains tax, on when that item is sold. So if they inherit it at 20 million, even though I paid 5 million for it, and they sell it at, say, 25 million, then they will get taxed on only that last 5 million. The rest will be non-taxed gained net worth that they have. And that's a really big loophole that is currently in our tax system for especially real estate moguls. And that's why Kevin talks about it a lot. So check out his video if you want a more thorough explanation of it, but that's essentially what it is. Biden wants to remove that. And the idea behind that is that, we don't need people to be hoarding so much money in the United States. That's his viewpoint, because it isn't helping anyone. Once you get past that 11.5 or that 23.16 million threshold, you're pretty set for life at that point, and it doesn't seem like it's going to hurt them too much. Also, I think it's really important to understand and recognize that the average American dies with no money. So this is not, again, affecting the average person by any stretch of the imagination. We have the inverse problem in the United States currently. And there will be a good link below from a study that was conducted by MIT going over how big of a situation this is. And as I hinted to earlier, Biden hasn't made specific claims about changing the percentage or the starting bracket for the estate tax. But in 2009, when Obama, was in office, the estate tax started at 3.5 million as opposed to the 11.58 million threshold today, and it was graduated progressive tax from 40 to 77%. So based on the other details of Biden's plan and the commonality, it would suggest that he probably is going to also want to push for lowering that threshold, or at least putting in a progressive taxation above the current threshold. Hard to say. And also there has been some statements from the IRS that they probably will not approve lowering the threshold for the estate tax. So most likely it would be a progressive tax, but that is my assumption. He has not stated that explicitly yet. As for the next set of taxes, we have corporate taxes. So this, of course, is going to affect anyone that is incorporated, or a actual corporation. Not if you're individual, this will not affect you, at least not directly. Basically, the corporate taxes are currently at 21%, and Biden wants to increase that to 28%. Now, prior to the 2017 tax cuts, I know that there's been a lot of hyperbole around how, Biden is super left and, wants to raise so much taxes. It's important to keep in mind that he wants to move it 7 points to 28%, when prior to the 2017 tax cuts, it was 35%. So he's not even, he's only getting halfway back to what it was before. So again, this is not anything obscene or, it's not an outlier at all. It's actually a pretty Republican tax plan, like historically speaking. Now he also though wants to double the minimum tax on foreign profits to 10.5% on multinational corporations. So the idea here is that, you tax these corporations that are taking advantage of cheaper labor outside of the United States by putting a increased tax on them. Now, will this make a difference? I mean, yes, it'll make a difference in as far as the revenue in the United States for this specific tax will be double what it currently is. However, if I'm paying someone, 1/5 or even half the price, when you include their wages plus the supply chain costs, if I'm paying that, in a lesser economically advantaged country, then that's not really going to deter me from doing that because it's only 10.5% difference. So it's probably it's a step in the right direction in my opinion. However, it's not, I don't think it's going to move the needle as much as people think outside of just increasing overall tax revenue. Another corporate tax that he is implementing, or a specific rule, if you will. So this is something that other people have coined as the Amazon rule. And so this is that Biden wants to put a 15% minimum tax on book profits, which he's referring to net annual income for companies with over 100 million in income. So again, this would only start after the first 100 million in income has already occurred. So this, for the most part, will not be affecting any, one that considers themselves a small business, unless it's the Lakers applying for a PPE loan. But, it's clearly targeted at companies like Amazon that will run very low profits or no profits or even loss to avoid taxation and take advantage of the current tax code as it stands. And that's the goal of that and why it has that name. As for healthcare, so Trump has stated that he wants to cut the funding for Medicare and Medicaid, while Biden wants, to move Medicare eligibility from 65 to 60. So move it 5 years earlier. Now, another important thing to understand historically is that when Hillary, for example, was running in 2016, she wanted to move this all the way back to 55. So again, Biden's not going even as far as Hillary when it comes to expansion of Medicare and Medicaid. He's only meeting halfway between Trump and Hillary. So again, pretty, surprising, not anything outside of the realm of imagination. And Trump also wants to repeal the Affordable Care Act, which is commonly referred to as Obamacare. And I think it's really important to understand that, 20 million Americans gained health insurance from this. This would be a very big blow to a lot of lower income Americans. And we'll see. Trump and the Republicans have said that they're going to make a plan. They did whenever he was running in 2016. But there has not been any, anything that has passed or been proposed seriously. So, I'm not going to hold my breath. That being said, Biden nor Trump support Medicare for all, which, 69% of Americans want, according to polling. Check that in the description as well. But, the point here is that no matter what any talking head tells you, neither of their plans are anywhere close to being socialist or, outside of the realm of normalcy. I definitely think there's a big issue with cutting Medicare and Medicaid because, again, a lot of elderly and disabled and, just Americans that are that need that help are relying on that. That seems to be something that we should probably keep around, but you should definitely read into that and, formulate your own opinions. As for the other tax credits that Biden wants to, so this is actually a pretty cool part and this is stuff that I was not as aware of as I should have been. They're pretty cool. So first one is that he wants to, so first of all, a tax credit, if you aren't aware, is say I make, and again, I'm just going to do this for easy math. Let's say I make, $30,000 per year and the threshold for taxation is 20,000. Then if I'm able to claim different things on my tax form, different tax credits to get that 10,000 tax credit, then what will happen is that will move my taxable income down from 30,000 to 20,000, which means that I would not pay taxes for anything above that 20,000 threshold, depending on which tax we're talking about. That's a general breakdown. You can look more in detail if you would like. As far as the specific tax credits that Biden is talking about reforming or implementing, he wants to implement a $5,000 tax credit for what he calls informal caregivers, which are loved ones and family members that are providing long-term elderly care. He wants to increase the child tax credit from $2,000 to $3,000 for children aged 6 to 17 and to $3,600 for 6 and under children during the remainder of the COVID crisis. That being said, as far as the definition of what he's going to call the line of demarcation of the end of the COVID crisis, I have not heard specifically. So, take that with a grain of salt. He also wants to increase the child and dependent care credit up to $8,000 per child, with a grand total of $16,000 that you can, use as a tax credit. And then he wants to increase the tax credits to $5,000 for the first year and to $2,500 for the second year. If a employer hires a person with disabilities and uses those, and then is able to use those funds for different, associated expenses. The ones that he specifically called out were education, housing, transportation, and also he is, in addition to that, suggesting that we provide $30,000 tax credit to businesses that improve access for disabled Americans. So those are both, pretty big suggestions. He also wants to reinstitute the full electric vehicle tax credit. So if you buy, an electric vehicle, a fully electric vehicle, in the past, it was $7,500 for the federal tax credit, and then it varied based on state. Same thing with a step down scale as far as the cycles that product had been out, and it gradually scales out. So essentially, he wants to move this back to what it was under Obama. So if you're someone that's interested in getting an electric vehicle or hydrogen fuel cell or any of those alternative vehicles, then this is something that you'd definitely be interested and could benefit from. And then he stated that he would support a carbon tax, but I haven't heard any specifics on that. So, take that for what it's worth. Then he also wants to put a $15,000 refundable tax credit for first-time home buyers. And the main change that he wants to make on this, because I believe this is what's already available, what he wants to change is that currently the tax credit is available in the following year's tax return. However, he wants to put it so that it's available at the time of purchase. So this would help lower income people or people that are, stretching to buy their first home, have a little bit more liquidity available to them within that first 12 months. So that would be the idea behind that. And then on top of that, this is a really pretty cool thing, especially for people like me that are renters. He wants to enact a new renter's credit to reduce rental and utility costs to 30% of income for low-income earners, as well as expanding the credit for building and or rehabbing affordable low-income housing. And as far as the threshold for what he is referring to as low income, I do not know specifically. However, I think that this is something that could be very good for the, average person that's trying to rent, especially in areas like Los Angeles, where I live, where rents are very often making up more than 30% of a person's income, especially if they are, making below six figures, which most people are. And then the other things that he has mentioned are he's mentioned some like not specific, but some different changes for retirement plans for small businesses, trying to find ways to fund, better subsidize those from the government so that, smaller businesses as opposed to just big corporations have better access to providing 401ks and, good retirement plans for their employees. And he's also talked about changing around the taxation for individual 401ks under a certain threshold so that people have a little bit more flexibility to move stuff around as far as like investment allocation and being able to maybe pull them out if they need to during a time like right now with forgiveness. However, again, I have not seen the specifics on that. The information I'm getting is from Kiplinger, and that is linked below. So definitely check that out. Now, that's a lot to think about, especially if you're someone that's not a nerd about tax policy like I am. And here's the main takeaway. So the main thing we want to keep in mind is that, and this is my opinion, is that Biden's plan is not perfect or who I wanted. But when you look at it, it definitely favors the average American as far as the changes that it's making through the tax credits and the increased revenue through the increases of taxation on the top 2% of individuals and corporations. I think that that's good for the average American. And now there is something to consider here, that while your taxes will not directly be increased if you are in the bottom 98% of people, there will most likely be some associated increases in the cost of consumer goods and services. There will be a link down below showing that from the Tax Foundation. I think it's important to understand that when you're looking to pressure test an idea, I like to look at someone who has every reason to disagree with my point of view and see how good their best argument is. And the Tax Foundation, which is generally a right-leaning, organization, what their estimations are that this plan would increase the cost of consumer goods and services at about 1.5%. So, in my opinion, that's pretty small. And also it would increase a good amount of revenue and help to chip away at the growing deficit that we have been, rapidly expanding over the last, since the early 2000s, especially. It really sped up, during that time period and recently. Again, the other main thing to keep in mind is if you make less than $450,000 jointly, and are leaving less than $11.6 million to your kids, and you don't make $1 million or more in investment income, then you only have to gain from these proposals. So as far as other policies, that's up in the air. That's depending on your personal perspectives, and what you value. But from a tax perspective, we can definitely see that the claims of this being outlandish or going to increase taxes for the average person just doesn't hold up to scrutiny. And so that's my opinion on the Biden tax policy and the proposed changes that he has compared to our current policy under Trump. If you enjoyed this clip, be sure to leave a like, subscribe, and check out the full live version of the Wealth for 99 podcast, where we talk finance, economics, and public policy from a working class perspective. We'll see you there.